My stocks and shares ISA on Trading 212 is currently valued over £63,000, and today I'm up by more than £3,000 on news that the US and China are set to lower tariffs and work out a trade deal. Today I'll be showing you my recent activity in my portfolio with 3 new buys and showing you my insight into positions which I still think are massively undervalued. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. Things are looking really good with this portfolio just today even. We're currently up to around about 63,900 or so pounds. We've got a total return of about 12,000 or so pounds. And we are currently today up around £3,000, which is around 5% because of the strengthening of the dollar and because of the China US tariff agreement / not agreement yet. So there's lots of things going on in the market. Things have shot back up and people are very hopeful for the future, and that's being reflected in this portfolio. But if we could see just here on the 5th of April, I was actually flat on my yearly returns. So essentially in a year, I had returned next to nothing, and I put around 9k in contributions into this portfolio. So really, we can see that I have been continuing to invest even in this period of volatility, especially when volatility was looking at its highest. And that's when the portfolio value has shot up and the gains have come up with it. Portfolio is sort of reflecting the market really. We've got the futures, because we're in the pre-market now, looking very good, soaring after the US and China broker deal 2/tariffs. What that actually looks like is that the market is up around about 3% or so on the news that the US will lower its reciprocal tariffs. So we've got here the US said it will lower its reciprocal tariffs on Chinese goods to 10% from 125%. And the separate 20% tariffs that the Trump administration imposed on what it calls the fentanyl trade will remain in place. And Beijing, in return, will cut its retaliatory levies on the US goods to 10% from 125%. This is probably like the best news that the market could have heard. This is like basically everything's going to be fine now because China and the US have figured it out. They're not going to war anymore. And now, of course, business as usual, and the stock market continues to race up, which is very good for the Trump administration because they will be up for their midterm elections, which I'm sure is just a coincidence. Bringing this all back to my portfolio though, we're now up by about 2% for the year in time-weighted return, and we have put a lot of money into this one in these lower sort of periods when we were down by close to 15%, and similar times to the market being down around about 13%. And we've kind of followed the market throughout this entire period of uncertainty. Looking to compare this in a nice little graph here, we can see that my portfolio so far, which we've been as tracking in 2024 and year to date in 2025, is doing fairly well against the indexes, but not really massively outperforming yet. Up by about 36% in 2024 and up by around about 2% now in 2025 year to date. Now if we track back a little bit and we look to what I was selling and buying during this past say couple of weeks or so, and I haven't really reported to you guys before, we've made a few little different deals. Now we've only done one sell more recently, and that was to sell out of Visa a little bit. So we sold 2 shares of Visa at $337 per share and have an overall value of about £503 from that trade, up by about £87 in overall return. And this is mainly because I'm seeing Visa as returning or yielding less than say some other performers which were underperforming for the year and have actually bounced back considerably in more recent times, especially today. In terms of what I've been putting that money into, my main contributions have gone into United Health Group. So I bought 6 shares or 6.45 shares at a overall cost basis of $418 per share. This is an overall value of about £2,015. Now I'm down a little bit on this position, down by about 7% or so, around about minus £140. But the way I see it is that this company is offering great value right now to its prospective growth. And even though they've recently cut guidance in their earnings report, they had a real terrible earnings report that just didn't go well for them, where they cut guidance and basically said that high utilization rates were causing such an impact in this business. But what I see right now is United Healthcare is an excellent management business with a strong shareholder-focused approach. They're an excellent dividend payer, and right now they're struggling, and the market is massively really getting back at them for it. In the past 3 months, they're down by about 27%, and year to date, I think they're down more than that. So the reality is I think this business, whilst it's suffering right now, is seeing a lot of short-term headwinds and will continue to for 2025. But the future looks very good for this business for its EPS growth rates. And over on X, I talked about what this expected return might be from these sorts of levels. So I've now said here that United Health Group is about 3.5% position, and it still is, a little bit less than that now. And they guide for about 13 to 16% EPS growth into 2026 and beyond, upwards to about 2028, 2029. And analysts share this point of view in terms of how their EPS will grow, so their earnings per share. Now, their PE currently sits around actual 15 now, or 15 or 16, and historically has traded at around a 10-year average of 24. So when we look at historical rates of how people have valued businesses because they want to own them for their dividend growth and because of their strong shareholder appreciation, then we can see how they might be being misinterpreted in price now, which I think is happening with United Health Group. So here I state, when I did like a free cash flow price to earnings expected return over the next, say, 5 years, I came to a potential CAGR about 18 to 22% from here for a PE of about 20. So that's where I see United Health Group potentially being able to grow. And it's a very good return for a business that I think is very high quality in this area. On the list, I actually added to one share of Amazon, which needs no real reason why. I thought it was misinterpreted, and I kind of wanted to get up to a round number in my share count, so I actually added a little bit of Amazon, around $176 per share, and obviously it's up considerably since then. Now, the one that I want to talk about a bit more of was MELI, because I actually added just before earnings, and they had a real stellar earnings report. So I added 0.2 shares, around about $2,250 per share, an overall value of £338. My reasoning behind making this buy at a time when MELI was up considerably for the year, about 25-26%, was because their still fundamentals are exceptional, and I expected to be exceptional going into this earnings report. Their revenue growth is 43% for the past 3-year CAGR. EPS year CAGR is 183%. And then on their price to free cash flow is actually around 22 times now, which I think is still very good for a business growing this quickly. And their 3-year CAGR for free cash flow is actually organically closer to about 100%. So I added to MELI, even though I thought it was up quite a bit. And then their earnings report actually came in exceptionally very good. They beat on the top and bottom line considerably. So revenue, it was 5.93 billion compared to 5.52 billion expected. So that was quite a big beat. And EPS was $9.74 compared to $8.27. So they beat hugely, up 37% in revenue and 44% year over year in EPS. And I'm seeing really good figures with this. Their credit portfolio is up loads, and I just think this whole business is exceptional, and I wanted more exposure in the portfolio. Which brings MELI up to my, I think, second best performing stock in my entire portfolio at the moment for year-to-date returns. And we're up by about 41% on the position with around about 2.2 shares. At an overall value of about £4,200 now, up by about £1,200, or around that 41%. And I just see this one as an amazing opportunity. It continues to compound. I'm not too concerned with short-term fluctuations. I was invested around this sort of point when I believe Argentina was struggling, and now Argentina is one of the fastest growing segments of their business because the local currency there has massively improved. The president there has improved the local currency's actual respective FX rates, and it's now slowing down considerably in inflation, which means that MELI can perform a lot better in this space and actually grow its revenue there. But overall, I really like this position. it's exposed to high volatile areas and economies, which is hence why I don't have such allocation to it as you might expect. It sits now around about 6.5% of the overall portfolio. Let's talk about my largest positions, the positions that I have the most conviction in, and maybe a few reasons why. So we have Amazon, which is my largest holding at over £15,300 now. I've got 97 shares at an overall value of about 15k, with it being up by about 13% or around £1,700. And the reason that I've dedicated so much research and evidence and growing profitability of Amazon is where I'm putting my money. Essentially because Amazon has such dominance in e-commerce that it is effectively becoming a more profitable business off the back end of its higher margined styles of business. That's their cloud service, their advertisement revenue, and their third-party seller services. Now, through this period, we've had a lot of volatility with Amazon stock. I was down considerably more than the market because of my overexposure to Amazon on certain days, because the tariffs looked like they were going to impact Amazon and still may impact Amazon. We don't know until the next following quarters in earnings reports. But I've always got the opinion that Amazon will do well despite any sort of fluctuations, because this one's done very well during recessions as well. And I just think it can recover from almost anything, really. So that's why I've put a lot of money in this particular portfolio. In the past year, it's up around 10%. In year to date, I think it's now roughly around flat. So I'm really not too concerned with how Amazon's performed. And in the past day, I think it's up by about 7%. So really, a lot of these gains have come from just today, pre-market. So I think this is because people were so concerned about China's impact on Amazon. A lot of their e-commerce side of the business comes from there. But one of the things that I want to talk about is the fact that this isn't just an e-commerce business. Forgive this for being a little bit blurry, but this is me talking on X about e-commerce and Amazon. And essentially the transition from online stores becoming massive parts of their revenue to being a lot smaller segment and it being a highly diversified business now. So we've got Amazon is not an e-commerce business. In 2014, Amazon's revenue was heavily weighted towards online stores. So that's around 77% of their overall revenue. And third-party seller services was 13%. Now, as of 2024, because that's all the data we have, then online stores now make up around 38% of Amazon's revenue. So this is a business that is becoming highly diversified. AWS, advertisement revenue, is becoming a lot bigger part of their ongoing revenues. So when we have disruptions in China agreements and tariffs, it will have less of an impact on Amazon overall bottom line, if you ask me, because their story is less about overall top line growth, even though it's 10% growing, which is still amazing for this business. But it's more about their growing profitability in EPS and, of course, free cash flow. And even though that free cash flow is artificially low because of their continued reinvestment into the likes of AI, I do believe that as the years goes on, they will either contribute less to AI or generally the free cash flow will just go up despite its continued capital exposure. So really, when we're seeing AWS now become 16.9% of their overall revenue entirely, and it's growing at 19%, I think this is a very good thing for Amazon's margins, and I think that this is a growing profitability story mainly, in my opinion, and that's where I've put my money. Then we have my second largest holding, which is, of course, Brookfield Corporation. This one, unlike Amazon, I think it's similar to Amazon in terms of overall size. We're talking around over 20% of the overall portfolio. And Brookfield Corporation, I have 323 shares of, an overall value of £14,335, up by about £1,516, or around 11%. And just for today, I think they're up by about 3% in pre-market. So essentially, this one's doing, again, very well on the day and is one of my larger conviction holdings. The reason that Brookfield is such a big player for me, and one that I've devoted a lot more continued research into, is because it's such a heavy compounder of the past. If we look at their presentation where they've showed their annualized return for 30, 25 and 20 years, we can see that this one has been a massive outperformer of the market and outperformer of amazing businesses like Berkshire Hathaway. So when I see an annualized return of 25 years of 19%, a 20-year return of about 16%, I think this one will continue to compound, maybe not at these rates, but certainly into the future, and I'm certainly seeing that in their current financials. They recently reported earnings where they had Brookfield Corporation reporting around 27% in increased distributable earnings to 1.5 billion, which is a re-acceleration that I wanted to see in this business because distributable earnings is essentially their free cash flow, and we're seeing that massively increase, and I think they were up by about 3 to 4% on the day. So distributable earnings is continuing to outpace their current growth. They expect to get around a 22 to 25% distributable earnings continued growth into the future. And this is one I expect to grow rapidly from my current share price. So I'm really seeing good things with this business. Then we get on to one that I'm actually down on, which is, of course, Google. Now, this is my Google position, around about 50 shares or so, up by about £5,950. We're down by about 5%, or around £300. And this is one that is doing fairly well today as well as the market, up about 2% just in the pre-market. And it's actually a position that I think has been beaten down considerably in the past year, down by around about 7%. I still like my position here, and actually I think this is one that is actually trading for really good fundamentals right now. It's just whether you can get on board with the fact that their search may be deteriorating, may not be, etc. I don't really buy that assessment. I think that LLMs may cut into Google's search dominance, but I don't think it will immediately oust them. I think it's too ingrained in society, if you ask me. And in terms of our real weighting, we've got Amazon sitting at 24%, Brookfield at 22%, and of course Alphabet, which is Google, sitting around about 9.4%. I'm happy with that level really at the moment, and we'll continue to review this ongoing dispute around search and whether LLMs are cutting into Google's financials. But I haven't seen anything really to justify that, if you ask me. Then we get on to more of a defensive holding, one that has great dividend growth and is effectively a toll booth style company, which is of course Visa, the credit card company. I have 18 shares at an overall value of £4,900, and we're up by about £1,152 on the position, or around 30%. And this is one we've trimmed a number of times, as we saw more recently, but actually we trimmed considerably before that to add to other positions that I think are trading for maybe better growth in the future, exceptionally, except I think this one will expect to return around about 13% from around here in EPS growth and stuff like that. So I expect Visa to do very well, and I expect it to hold up very well if there is a market downturn. But at the moment, it's reaching all new highs, and I really like having this as a substantial holding in my portfolio. At the moment, its weighting currently sits around 7.75%, and I really like it there. It was sitting closer to over 10% before, but I've actually brought it down in its weighting because I've actually been adding to other positions. And now that my portfolio size is getting so large, I actually have to consider selling out of positions to make a sensible sort of size position when I'm looking to invest in new positions or significantly in others. Now, in terms of weighting, we have ASML. We have about 8 shares, an overall value of about £4,400, and we're up by about £940 on this position, or 26%. Now, this is one that I actually was buying into around about the $630 mark. So really, I'm actually not up this high. The only reason that my cost basis is this high is because I basically I bought it in my invest account and then transferred it over into this account, which was in my previous videos. So essentially, we're not up this high. We're actually down a little bit. And now we're actually up by around about, probably about £500 or so, something similar to that. But essentially, this one is doing very well. I still think it's offering really good value, and obviously we got it for a very good level. I really like ASML as its global dominance in monopoly of patterning, specifically in the semiconductor space. They have about 90% overall dominance in that area. They've got a continued scientific advantage against their peers. This one's really good for its future EPS growth, in my opinion, and will probably return very well from here. Now we get to one that I have tried to pad out. I did have like 2 shares of this like 6 or so months or so ago, and I really wanted to add to it, but it was still sitting fairly high, and then I got an opportunity earlier on. And this one is around about 11 shares, S&P Global, a credit ratings and financial analytics business, up by about £4,300. We're up by about £600 in the position, or around 16%. This one over the past year is up 20%, has done very well. We actually invested here considerably around the $450 mark to get it up to where we're sitting around 11 shares, and that wasn't that long ago. So I really like S&P Global as a business market dominance. They are the biggest credit rating industry for the 3 businesses that are sort of in that area. We've got Fitch and Moody's that work alongside them. And they have dominance there because essentially the way the US works is that everyone needs to finance their own loans, and companies need to do this to get it rated so that they can have a certain and suitable interest rate on their loan amounts when they choose to borrow money to reinvest back in their business. And S&P Global have to get paid a substantial fee to do that. They have just got such a grip on this area, and with them being the owner of the S&P index as well, which is growing in popularity, I think S&P Global is very likely to do very well into the future, and I love its dominance in its area. So now that it's sitting at $520, I don't think it's offering such good fair value, but I do believe this one is a very good buy when you can get it on a lower dip. In terms of its weighting, it's actually sitting around about 6.85% now, which I'm really happy to have got back up. I would like to see it maybe get up to around about almost 10% into the future, with ASML sitting around 7% as well as another monopoly that I like exposure to. Now moving down our list, we get to Brookfield Asset Management, which is essentially one of the businesses involved in Brookfield Corporation. It's their main contributor to their distributable earnings, and it's round about, I say, owned by about 80% of Brookfield Corporation. They have publicly traded shares, which I bought separately when there was a big market downturn, when we was at the height of this tariff concerns around a couple of months or so ago. I found a month or so ago, I think, I bought into this one. And we effectively invested right at this dip. Now, I really don't time things this well. This was very fortunate. I don't usually do that, so don't rely on me to do that in the future. But we have 71 shares, an overall value of about £3,100. We're up by about £660 in the position, or around 26 to 27%. This is again one that's doing very well today, up 2% like everything else is. And I really like Brookfield Asset Management for its future potential dividend growth. It's a lot simpler of a business than Brookfield Corporation. And as I've highlighted in the past when I bought into this one, I think people will be more willing to give a higher multiple to Brookfield Asset Management than they will Brookfield Corporation, because they see it as a capital light business that is very simple. And I think that puts a bit of both a sort of bottom on the stock so that it won't go that low, because as we see here, it hit the sort of bottom. That's when its dividend yield hit a certain level, and I thought that was a good buying opportunity. So that's when I put a lot of money into this one. That's when I sold a little bit of Visa to put into this one, and it's done very well since then, outperforming Visa. Now we get on to Texas Roadhouse, which is one of my smaller positions. Around 18 shares at an overall value of £2,500. We're up by about 50%, or around £843. This is a position I've owned for a very long time. They recently reported earnings and did very well in those earnings. If we look back to about 3 months or so ago, they shot up around the time they reported earnings because they did very well with earnings, better than expected. I think they missed slightly in terms of their revenue growth, but outperformed in their EPS or something similar to that. So they did very well. I really like Texas Roadhouse for its runway of growth in America specifically. And I think that they will do well as long as there isn't a recession where they may slightly underperform, as all restaurant businesses will likely to do. But it's always very busy over there. I'm always looking into reports where they are very busy. And I like the fact they continue to open up restaurants, franchising, etc. They're doing very well in their space. Now we get on to my second to smallest position other than United Health Group. only through sheer gains, really, if I'm honest, not really through capital allocation on my part. And that is, of course, Hims and Hers Health, which is a healthcare business that is more of a disruptor in this space, not a market leader. Although I would say they're the market leader in the disruptive space, if that's possible. So we have 51 shares at an overall value of £2,100 now. We're up by about £1,000 in the position, or 98%. It's the best performer in the portfolio as of right now. If I'm honest, I've been here before. We had this before in February 2025 after the Super Bowl. They did really well and they were getting on everyone's maybe last nerve in some cases. But Hims and Hers were up to about $60 per share, and obviously my position was held throughout this period, buying around here at $26 or so. And now we're in a similar sort of position again, up $56, but this was off an earnings report. The earnings report was very good, very favourable. They had revenue growth over 100%. They sort of have shown really that they're not just a GLP-1 company, which a lot of people seem to think they are. So I really can't call this one. I'm not selling out of my position at the moment, even though it's up so much. I know looking at this graph, that seems crazy because we've seen a lot of volatility like this, and we could see that again. We could see Hims go back down to the levels we saw. I think that's unlikely because it's earnings supporting it rather than sensationalism surrounding Super Bowl ads. But overall, I think this one is a really volatile business that I want as a smaller percentage of my portfolio, mainly because the business is so great. I recently watched a Hims and Hers sort of video, which is Hims House, where they interviewed the CEO. There was some really good things that they spoke about with Hims and Hers Health. There was some quite good points where they talk about regulation, and he really goes into a bit of detail how well they're insulated from these regulatory concerns surrounding lawsuits and stuff like that, which I think is the key sort of concern around Hims and Hers. My main concern with Hims and Hers, and why I don't have a bigger allocation to it, is their competitor space. There's a lot of businesses that are similar to it, like Roman Health, which are trying to rip off Hims and Hers. At the moment, Hims and Hers has shown exceptional resilience in this space, exceptional growth, and I expect that to continue, which is why I'm invested in them. But the competitor space is where I have my concerns, because I see a lot of similar business models to theirs in this healthcare space. And even though Hims is the first mover advantage, I could see that maybe being closed in the future. So I'm keeping a close eye on that. But at the moment, its allocation sits around about 3.46%. And generally, I could see that staying at that sort of level. I don't see that maybe going up much more unless it shoots up in share price. Year to date, they're up over 100%. And I really wouldn't like to call this one because I don't know where the bottom or the top of this stock really is. So that's why it's maybe a smaller allocation in the portfolio. That's about it for this portfolio. Here are all my positions. Obviously, some are I have more sort of fixation on and control over into the future. I still think that some positions are offering a lot better value than the overall market. Google is down on its luck right now, but I expect that to do fairly well. United Health Group, similar position. It's down on its luck right now. Revision and restrictions in earnings, but I do believe this one is being massively devalued by the market at a time when the market is racing up in value. This is likely where my cash will look to go in the future at a free cash flow yield of over 7%. Just to see year to date which stocks are outperforming and which ones are underperforming, we have here Google and United Health Group looking very underappreciated year to date. And this is sort of up to date as of today because I updated it. So what I'm seeing here is United Health Group and Google sort of down on their luck, with the likes of ASML looking like a good competitor as well. Amazon and Brookfield Corporation I think will still offer good value for this point, and I have high exposure to them already. Hims and Hers is up massively, obviously for the year, outperforming almost everyone. MELI up considerably, mainly on earnings, which I think is to be expected with this amazing business, which is why I added more to them, because I think they're great. Visa is up, but I think that's more due to uncertainty, and generally I don't think it's massively due to outperformance, although their earnings report last time was actually quite good, where they beat on the top and bottom line. So overall, this is how the stocks are performing year to date in my portfolio. But thanks for watching, I appreciate it, and as always, I'll catch you in the next one.